Hello, everyone, and welcome. We're going to give folks a few seconds to migrate in from the waiting room. Good morning. Welcome to COVID Relief You Can't Afford to Overlook. I'm Amy Music, Coordinator for the New Jersey Business and Industry Association. With us today is Mark Evelyn and Michelle Benton, co-founders of Versus GP, LLC. A few housekeeping matters before we get started. Today's webinar is also being recorded and will be emailed to you tomorrow along with the PowerPoint for today's presentation. So be on the lookout for those. If you just can't wait, you can download them right now from the Hand Up tab. But I'd also like to draw your attention to the Questions tab. The speakers would be happy to take your questions at the end, so get to them as they come to you via the questions chat box. If you have any trouble viewing or hearing during this presentation, don't forget you will automatically be receiving your recording within 48 hours. So if you have to sign out and watch the recording, you won't miss a thing. So now, without further ado, you go ahead and take us away.
Good morning.
Good morning, everyone. If we could go to the first slide. All right, so welcome everyone. Glad to have you here. A little bit of background about Verus and Verus GP. Verus GP is a subsidiary of a larger firm, Verus, which was founded 19 years ago. I'm one of the original founders. And Verus started off as a firm focused on, as I put it to many people I talk about to explain what we do, we're in the business of finding money and distributing it to people who need money. And over the last 19 years, we've been doing that for concentrating largely on large settlement funds created by Chapter 11 bankruptcy proceedings and other forms of settlement funds that have been created through class action mechanisms and even private resolution programs. And over the course of those 19 years, through those various settlements we've administered, we've actually found over $6 billion in money and distributed it. And that's been to the benefit of over 6 million individuals over the course of the first 19 years of our business. And I think you can tell I've got a little gray in my beard as evidence that it's been a long road. It's been a lot of interesting work, but it's a lot of complicated and challenging work as well. We have over 100 members of the team focused on this work, and we are organized into 4 main practice areas that all contribute to doing that work of finding that money and distributing that money to deserving individuals and businesses. If we could move to the next slide, I'll give you a little background on what those practice areas are and how this fits together to the solution we are talking about today of helping small and mid-market businesses find government money that's available to help address the COVID-19 pandemic and the after effects of it. So we have, if you could go to the next slide, please. Our solutions fit into 4 broad categories. We do a lot of data science and analytics work. We're experts at collecting complicated data, analyzing that data to reveal insights and sharing those insights with our customers. That is a big part of what we are doing in this space with the employee retention tax credit. There's a big part of this work that involves collecting financial data and payroll data and analyzing that to determine eligibility. We have a large practice area involved in what we call case management. That is, again, collecting documents and various forms of information and reviewing them to determine eligibility for various settlement programs to see if those claimants, whether they be individuals or they be businesses, are eligible for funds that have been set aside, whether that be through a bankruptcy proceeding, some government grant program, a class action settlement, whatever that source of funds is. We help claimants determine whether or not they should even file a claim. We have a business and advisory practice that focuses on compliance matters, finance and accounting, and a very sharp team of CPAs and finance professionals who assist our clients with managing the funds that have been created to be distributed to claimants. And finally, we have our settlement administration side of the business, where we're actually reviewing, validating, and qualifying claims on behalf of the trustees or the government agencies that have set those funds aside. We're actually hired as a third-party administrator to distribute those funds to claimants. As we reviewed what was going on in response to the pandemic and some of the government efforts, legislation that was passed in early 2020 through the end of 2020 to address the pandemic and make money available for various industries and individuals, we dug into the CARES Act and we dug into the American Recovery Plan Act. And this employee retention tax credit, it occurred to both Michelle and I that the core competencies we've developed to do what Verus has been doing for the last 19 years lent themselves very well to addressing the needs of small businesses when it comes to determining whether or not they qualify for this employee retention tax credit, which is just one element of programs that were created by the CARES Act and the follow-on American Recovery Plan Act. And we looked at that and we said, well, we've got a crack accounting team. We have all these great data scientists who are really good at collecting and cleaning data. And we have all these claims analysts who are really good at dotting the I's and crossing the T's and filling out the appropriate paperwork and making sure we've properly assessed eligibility so we can put the best case forward for our clients. Combining all those skill sets, it made perfect sense to us that we have the solution for the employee retention tax credit. And if we move to the next slide, I'll hand it off to Michelle to explain the other elements that we've brought onto the team to bring in other areas of expertise necessary to make this program work to the best benefit of our clients.
Great. Thanks, Mark. And as Mark mentioned, he founded Verus 19 years ago, but I've actually known Mark before that. We've worked together for the past 27 years in getting these 6 million clients, these various funds that are available out there. And I personally work with Mark on behalf of about 60,000 clients over the years. But there are also some things that I have done without Mark that are related to some government programs as well. One of the things that I did after Hurricane Katrina, we established a subdivision and used community development block grants, government funds, to fund low-income housing for residents on the Mississippi Gulf Coast. And I'm actually proud to say that that subdivision that we started was 100% concrete homes for the residents on the coast to try to withstand the hurricane winds. And I also participated on behalf of several hundred clients in the BP oil spill here on the coast. So partnering with Mark from Verus GP, I've put my 27 years of legal experience together with his CPA team, and we've also retained the expert services of several tax attorneys throughout the region so that we can more specifically address some of our clients' more complex matters. And we will discuss on the next slide what Verus GP has been up to on our first venture. So as Mark alluded to, the employee retention tax credit was established in the CARES Act. A lot of people never heard about that because when the CARES Act first came out, PPP was the big focus. And at that time, you had to elect whether you were going to proceed with a PPP claim or an ERTC claim, as we call it for short. And since the PPP at that time was more lucrative for a lot of businesses, that was the way businesses went. So at that time, they would have been precluded from filing an ERTC claim. But along the way, as Mark also mentioned, the American Rescue Plan changed things up a little bit, and they said, okay, now you can receive PPP and ERTC funds. problem was with that was they forgot to tell people that they could be eligible for both. So that's what Mark and I are getting out to small business owners throughout the country, is the fact that they could be missing out on these ERTC funds if they haven't looked at it yet. And the ERTC funds are actually a refund of a portion of the payroll that the business paid in. We can also include health care premiums paid by the employer, and in some cases 401k matching contributions. All of those things will increase the amount of the ERTC credit that the business can receive back. Now, this credit along the way has gotten a lot more lucrative for businesses. In the beginning, under the original CARES Act, the credit was only $5,000 per W-2 employee for the entire year of 2020. That amount increased to up to $7,000 per year, $7,000 per quarter per employee for 2021. So that gets a business up to a maximum of $26,000 per W-2 employee. And we look at the wages that a company paid at the beginning of the pandemic, which is determined to be March 13th of 2020, and the program goes through September 30th of 2021. Now, there are some other common misunderstandings with businesses out there, in addition to thinking that they may not be eligible for ERTC because they received PPP. The biggest misunderstanding that I'm finding is businesses think that they must have a decline in revenue to qualify, and that simply is not true. In a moment, we'll discuss the two different ways that a business can qualify, and a revenue decline is simply one of the two tests that a business can meet. Now, a lot of businesses we find did have a discussion with a tax preparer early in the pandemic in 2020, and their CPA or tax preparer may have said, we've looked at this for you and you simply don't qualify. That may have been true in 2020, but with the changes to the plan in the American Rescue Act, that opened up the door for a lot more businesses to become eligible. So even if you've been previously told you do not qualify, it's certainly worth it to take another look to see if you qualify with these changes, especially since Verus GP will offer these services to you at no cost unless we actually recover a credit for you. So you have nothing to lose by letting us look at this for you again. Now, the time periods that you can qualify for have also changed. Initially, the ERTC was allowed through the fourth quarter of 2021, but when President Biden enacted the infrastructure plan, he did away with the fourth quarter of 2021, but we still have first 3 quarters of 2021 that you can qualify for. Now, there is a limited amount of time to qualify. Initially, they said you had 3 years to file for this credit. That's going to be 3 years from the beginning of the pandemic. We're already 2 years into it. So according to the CARES Act, there's still another 12 months. But as we've seen, the president can change this program by decreasing the amount of time that you would have to qualify. So it's best to get it in early. And if we'll go to the next slide, I'll tell you about the 2 tests that we examine to see if a business qualifies.
Hey, Michelle, I'll just chime in here and I'll say, I think one of our main missions at Verus GP is just correcting a lot of the outdated information that's available out there in the marketplace, which is a big part of what we're doing here, is trying to educate small business owners on how this program has changed. And there's misinformation out there, or outdated information, even on the IRS website.
Definitely.
Because they leave things up there with little caveats in the fine print that says this information has been revised and is outdated, but they don't tell you where to go to find the most recent information. So it's a complex puzzle figuring out what the criteria are and what this program, the outlines of this program actually are today. It's a big part of our job, is just educating businesses.
That is correct. And of course, we've had 24 months of IRS guidance now. So we have the benefit of looking at that. But I always caution people, they say, well, why should I use your service as compared to this other service there that's advertising that I can get $33,000 back instead of 26? And I said, well, if you want to go with a firm that is using outdated information on their website, be my guest. Because if you see that number, you know that that firm has not updated their information to reflect the fact that Q4 of 2021 is no longer on the table. So if you see that number, that's why there is a difference. So as we briefly touched on before, the 2 ways that businesses can qualify. The easy one, but the one that I find a lot of businesses don't meet, is the decline in revenue test. And one reason it's very difficult for a business to meet this test is because if the business was open, we see, oddly enough, that a lot of businesses actually surged in revenue-wise during the pandemic. If the business did decline, they may have declined 30 or 40%, which is a lot to that business, but under the terms of the CARES Act, the business would be required to show a 50% decline in revenue when compared to 2019. Now, let's get a little bit easier under the American Recovery Plan portion of it, because for 2021, the business need only show a 20% decline when compared to the same quarter in 2019. All right, so that's our revenue test that we look at. The second test is if the business had a complete or partial suspension of its normal business operations. Now, a lot of people I speak with say, well, we were essential business, so we never had to close. The Act does not require that the business close, only that a portion of your normal business be suspended. Now, few examples of what I call partial suspension. Let's say that you're a restaurant business and the government orders in your state said that you could no longer have in-room dining, but you could set up a little cafe on the sidewalk, or you could offer takeout services. So that government order actually totally suspended in-room dining, but it would have partially suspended the entire restaurant's normal business operations. In the case of medical care providers, we see a lot of state orders that dictate the types of procedures that those medical professionals can perform. Dentists may not be able to do routine cleanings, but they can do root canals. Surgeons can do emergent surgery, but not elective surgery. So that is considered a partial suspension of their operations. There are a few industries out there, non-essential businesses, that were totally shut down for some period of time and then partially suspended for a time period after that. A good example of this situation are health clubs, spas, hair salons. At least for a couple of months in 2020, almost every business I know in this category would have been totally closed, usually from about March until May, depending on what state they're located in. And then after that time period, they would have only been able to operate at a limited capacity. Some restaurants would have also had capacity limits as well. And by that, I mean, you've got government orders that say, okay, well, you have to figure out the total number of people that you can normally have in your business. And I know they base that on square footage. And you are only allowed to have 50% capacity. Actually, some states were very restrictive, and for many, many months, they could only have 25% capacity. Eventually, they'd get to 75% and then fully reopen, but that took in excess of a year in many situations. So that's an example of industries that suffered total and partial suspensions of normal business operations. And the government orders that we look to determine whether the business meets this test can be anything from a presidential proclamation, which would have restricted travel or port mandates, all the way down to health department guidelines. Everything in between. Actually, most orders are going to fall in between and be your state governor's orders or your county and city orders. And we at Verus GP look at every business individually and determine which of these orders apply. And it's a pretty complicated analysis when you get into it, because as Mark points out, he lives in one county and works in a different county, and the regulations were different. So we really have to know what the government orders were in the county in which the business is located to know all of the impacts that business would suffer.
And Michelle, if I could chime in here with a question, because I hear this speaking to clients all the time. If I had more than one location for my business, does that complicate the analysis?
That's a great question. And I find that it actually makes my analysis easier because it opens up other jurisdictions that may have had more restrictive orders. And there's a good example of that in a business that I worked on several months ago that had a location in Mississippi and a location in Louisiana. It was actually located in the city of New Orleans. And New Orleans, like New York, New Jersey, Pennsylvania, Hawaii, California, had some of the most restrictive orders in place at the time. So while that business qualified for a certain period of impact in Mississippi, it qualified for several months longer of impacts in Louisiana. And the way the ERTC Act is written, if one of those locations is impacted, you are able to say that that impacts the entire business at all locations. So in that situation, we were actually able to get that business more of a refund because they had multiple locations.
So it can get quite complex pretty quickly.
It does. But we're prepared for it. This is what I have been spending 100% of my time on for the last 8 months. And we've got a good staff at Verus. We know how to look for those things and use them to the client's advantage. Okay.
And I think that takes us to what's the big benefit here for businesses in this program, which on the next slide, just to put a little more color and detail on this. We have a saying around the office here at Verus GP that cash is king. Actually, we're 70% women, so our saying is cash is queen. Businesses, it's the oxygen businesses need to survive. If you don't have cash, you're not going to be in business very long. And what this program does is it provides cash for businesses to help them get back on track, back on their feet, and recover from the after effects of the pandemic, so we can emerge from it stronger. Over the last 2 years, there have been wide-ranging impacts on businesses all over the country, and probably some of the biggest impacts here in the heart of New Jersey because of the nature of the restrictive orders that were in place here in response to the pandemic. So this is a rich source of cash for businesses to help you fuel your future growth as we emerge from this pandemic. As Michelle kind of touched on talking about the eligibility, there's 2 different time periods that we need to look at in terms of determining how much cash your business could potentially receive from this program. So we look at it in terms of 2020, where it's up to $5,000 per W-2 employee for the entire year. And by year, we really mean the portion of the year from March 13th through December 31st of 2020, $5,000 per W-2 employee. Now, the eligibility assessment, as Michelle also explained, it gets very detailed, and it's based on orders and impacts on your business, the facts and circumstances specific to your business throughout that time period. You may not be eligible for the entirety of those 3 quarters of 2020, but using our understanding and knowledge of the IRS guidelines and our knowledge of the government orders in place in your specific location, will determine what periods of time you are eligible for, and that will help us get to what the total amount of the credit that may be due your business is. As we also mentioned, Michelle mentioned, this is available for the 2020 time period for businesses with up to 100 employees. It's important that we emphasize it's 100 full-time W-2 employees. We've seen a lot of businesses who initially were told they did not qualify because they may have had 110 employees. Well, when you actually look at the specifics and the details of their payroll, they may have had 90 full-time employees and 20 part-time employees. And the IRS regulations are pretty clear on this point, that the threshold, the cutoff point for 2020 eligibility is full-time W-2 employees. So if you had fewer than 100 full-time employees and you had a whole bunch of part-time employees, you're still eligible for the 2020 time period. And this applies to a lot of service businesses in particular that may be more dependent on part-time employees, like the restaurants and hospitality industry. Looking at 2021, same sort of criteria, but now we're looking at a much richer benefit. It's quarter by quarter, and it's $7,000 per quarter. So we're still looking at government orders that were in effect and other impacts, the domino effect of the pandemic, impacts on the supply chain and such, to determine what specific periods of time your business is eligible for, to determine how much of that $7,000 you get for each quarter for each full-time W-2 employee. Part-time employees are also included in the credit calculation, but not included in the threshold determination of how many employees you can have in order to qualify for the credit in the first place. 2021, they also enriched the program and increased the size limit for what are referred to as small eligible employers. Now it's open to any business with fewer than 500 full-time W-2 employees on payroll. So that sweeps in a whole host of businesses that were excluded for 2020. And when you step back and you look at the statistics, that's about somewhere between 13 and 15 million businesses in the United States are potentially eligible for this program. And probably most of the folks on this listening in on this webinar fall into that category. Now, for the entirety of 2021, as Michelle mentioned, just to emphasize it again, it's available from January 1st of 2021 through September 30th of 2021, $7,000 for each of those 3 quarters covered by the program. That's up to a maximum of $21,000 per W-2 employee. So you add those two up, that's how we get at this $26,000 maximum credit that Michelle talks about. What do we actually see? Oh, go ahead, Michelle.
Oh, I was just going to say it was interesting because I've had several businesses that qualify based under the government orders impact test. Let's say that they qualified under that method for 2020 in the first quarter of 2021, and their business was fully opened and they did not have a government order impact. But if they had that decline in revenue for, let's say, quarter 2, then they can still be eligible for quarter 2. So you don't have to stick with one test or the other. It can kind of be a hybrid and increase that business's eligibility period using that other test.
Yeah, that's a great point. It's an either or assessment, and for every payroll period you're looking at, could be one test or the other that could create eligibility or determine eligibility for your business.
Right.
Now, what are we actually seeing when we go through this analysis for our clients, and what are businesses actually seeing in terms of their credits? If we move on to the next slide, we'll just share some quick statistics with you. We've been keeping track of this by different types of businesses. Since we've started doing this work, the average client that we've finished the eligibility assessment and the calculation determination of the credit amount for has had 25 full-time employees on their payroll. So we're talking towards the smaller end of businesses. We've done this for businesses with well over 500 employees, 400 full-time employees and another 300 part-time employees, but our average is around 25 employees so far. And we've qualified those businesses for an average credit of a little over $14,000, but it varies, as you'll see from the chart on the right-hand side of this slide. It varies quite a bit depending on what specific industry your business is in. And these are averages. We've seen some businesses in the categories lower down on the chart who are actually getting much more, some getting a little less. But you'll see it's clustering around that $14,000, $15,000, $16,000 range, which is a significant amount of money for a business with 25 employees. We're seeing some businesses, many of these businesses, qualifying for upwards of $250,000, $300,000. We've seen credits in excess of $1.5 million for clients, and some well in excess of that amount. It is all dependent on how many employees you have, but also what time period you qualify. And the businesses with the greatest impacts tend to be businesses that had eligibility that covers the full or most of the 6 quarters this program is available for. It also has a lot to do. Oh, go ahead.
I was going to say, it's also dependent heavily on what the employee is paid, since it's a refund of the payroll.
Exactly. So wage levels matter. So this is going to vary based on geographic regions and typical wages in that region. It's also going to vary based on the mix of full-time and part-time employees in a business. So you'll see the businesses with lower numbers at the bottom of the chart tend to be those industries that have a greater proportion of part-time employees on their payroll. So they're not making $50,000, $60,000 a year. They're making something less than that, and therefore getting less of the credit. One thing that we didn't touch on, Michelle, that I think is important to emphasize is that there's a cap on qualified wages. So in order to determine the full amount of the credit, the IRS says that you can apply for a credit up to $10,000 in qualified wages per employee per time period. So in the 2020 year, it's $10,000 for the full 3 quarters of 2020, and then there's a multiplier applied to that. It's 50% of that $10,000. That's how we get to the $5,000. So in 2021, they changed it to 70% of that $10,000 per quarter, which is how we get to the $7,000 per quarter. So if you had an employee who was making anywhere above $40,000 a year, you're going to most likely qualify for the full extent of that credit, with the exception that if you accepted PPP funds, there's a dollar for dollar offset against those wages for the money you receive from PPP. So we reduce the gross wages by the amount of the PPP funds that the business received.
There is, but I find that the way that its program is structured, although we have to account for every dollar of PPP funds, it really doesn't reduce the employee retention tax credit amount dollar for dollar.
It is proportional, yes, and there are allocations that you can use to apply a portion of payroll to other expenses, which is another important thing to understand. The PPP program allowed you to use up to 40% of those dollars for other expenses. So that can reduce the amount of dollars from the PPP funds that you deduct from your qualified wages for the employee retention tax credit. And it also allowed the allocation of PPP funds to owner compensation with a cap on the amount of owner compensation that can be covered.
Right. And another thing I'd like to point out, somebody says, well, I only have 15 employees working. Well, that business may have 15 employees working at any one time, but over the time periods of the ERTC program, those 15 employees may be comprised of 30 different people coming and going at a time. And you are actually able to get a credit back for each and every employee that you had during that time period, not just the 15 you may currently have.
Good point, Michelle. There's one other wrinkle before we go on and talk about the process of how you go about working with Verus GP to determine whether or not your business qualifies for this credit. And I think that, Michelle, you've spent a lot of time working on this, and you've actually helped a fair number of businesses that fall into this category. Many people who are aware of this program think it's only available for businesses that were in existence as of March of 2020, like businesses that were already doing business. There's a specific provision in the program for businesses that started during the startup businesses that were created during the pandemic. So Michelle, could you give us a little bit of information on that?
Sure. Under the initial CARES Act, there was no mechanism for those startup businesses to be paid under the ERTC program. When the second plan, the American Recovery or Rescue Plan, came out, they did specifically include a recovery startup provision. So the rules for those businesses are dramatically different from a business that was already an ongoing concern before the pandemic. To qualify as a recovery startup business, the requirements are really easy. The first one is that the business started after February 15th of 2020. The second requirement is that the average annual revenue of the business be less than $1 million. We don't have to look at revenue decline or government order impacts at all. Those are your two criteria for a recovery startup business. The benefits available to those businesses are a little bit different. Those businesses would be eligible for the credit in Q3 and Q4 of 2021. So this is the only type of business which can receive the ERTC for the fourth quarter of 2021. So in this situation, we would actually get the business's payroll information and other details through the entire year of 2021. And those benefits are capped at $50,000 per quarter for the business.
So it's an interesting little wrinkle that opens up the program to an even wider spectrum of businesses. Mm-hmm. So why don't we move on and just talk briefly about the process of how we go about helping clients. So if we go to the next slide, Michelle, if you could explain the first part, and I'll cover the second half of the process.
Okay. The first thing we do is we have businesses fill out a simple questionnaire. It's 3 pages. It will help us determine first whether or not the business meets the employee cap, that 100 or 500 employee cap that Mark spoke about before. We ask a little bit of information on quarterly revenue, so we can see if the business would qualify under the revenue test. Or we also ask a series of questions about what impacts the government orders may have had on business, to enable us to go research the orders and see if the client would qualify and for what particular orders they would qualify under the government order test. So once we get that information, that gives us a little idea of what direction we need to head with the client. So we'll schedule a phone call or face-to-face meeting with someone who's familiar with the operations of the business. Usually it's a co-owner or a bookkeeper of the business. We will sit down with them and go through in detail, how the business operates, where they operate, what their impacts were, put that together, and we do a lot of research and determine first if the business is eligible, and second, the time periods of eligibility. One thing we didn't really point out before, but if you noticed on Mark's chart of the average amount that businesses receive for employees back, you'll notice on the top of that list was nonprofit category. So that's one change that they made as well. Nonprofits are eligible. So when we conduct the eligibility interview, we'll ask you if you're a profit or nonprofit company, but being a nonprofit company is not going to kick you out of eligibility. All right, if the business passes the eligibility test, we determine that you look like you have a claim, then we will get a little bit of documentation from the business. It's not nearly as invasive and in-depth as the documentation a business would have had to compile for PPP. But the information we need is going to consist of the business's payroll from March 13th of 2020 through September 30th, 2021, or in the case of a startup business, we would only get that payroll information for the third and fourth quarters of 2021. We would also get a list of the healthcare premiums that the employer paid and 401k matching contributions by the employer. We collect a little bit of information about your PPP award. Usually all the information that we need can be found in that 3508 loan forgiveness application, right? And then the final thing that we have to have is a business's 941 quarterly payroll tax returns. So we look to see, have to make sure that the business actually paid in the payroll taxes, and we get that information and we will file an amended 941 for the business as the mechanism for claiming the employee retention tax credit. We mentioned briefly that it's W-2 employees, but I want to point out specifically 1099 employees are not eligible for the ERTC.
That's a great point, Michelle. So once we've collected all that information from your business, from that point forward, it's a matter of analyzing all that data, cleaning it to get it in the appropriate format, and then performing the rather complex calculations to determine which employees are eligible for how much of this credit, which means allowing for certain deductions and disallowances from those wages that you paid your employees for PPP and other federal tax credits that have to also be taken into consideration. And there's a number of them. There's about 8 different forms of federal tax credits that have to be taken into consideration here. And if you've received any of those credits, that we have to deduct those from wages as well. Once we've calculated what that credit is, as Michelle mentioned, we will complete a amended 941. That's your payroll tax filing that's done on a quarterly basis. This is an amendment to those 941s that you previously filed for the quarters that are in play here. That amended 941 will be sent to the owner of the business or their authorized signer, a CFO, whoever is authorized to sign that document. And once you've signed it and returned it to us, we will take care of filing it with the IRS and then tracking the IRS's receipt of that and monitoring it from that point forward. It's important to point out here, I think, that while this is a direct cash refund, the IRS is cutting checks and actually physically mailing checks to businesses. They're not making electronic distributions. They're not sending them immediately. There's about an 8 to 10 month backlog of various tax filings with the IRS right now. They're being very upfront about this. So once we file those amended 941s, you can expect that you will not be seeing that refund for about 8 to 10 months. Another thing, if you need if you're looking for that cash this year, if it'd be really beneficial to have that this year, we're emphasizing with businesses that you want to take action right away, because if you don't get that amended 941 in by April, you're unlikely to see the refund in the 2021 calendar or 2022 calendar year. You're probably going to see it in the first quarter of 2023. Once the IRS has it, it's pretty much just waiting for them to process the documentation and issue the refund. As we kind of touched on, Verus is not charging for the service up to this point in time. We'll do all this work. You're not paying up front for this. We only get paid once you actually receive your refund from the IRS. Important to emphasize that it's a low risk proposition for us to do the eligibility assessment. If we determine you're not eligible, you don't owe us anything. And this is another thing where we think there's a big part of the service we provide is educating the business community. You will hear from other vendors out there who are doing this type of work that everybody qualifies. Everybody is eligible for this credit, and that's just not the case. We believe in playing this by the book, doing and taking a conservative approach and not pushing the limits of straining the interpretation of what the IRS guidelines are. And if you're not eligible, we'll be upfront with you and we'll tell you that. And there's no cost for that service.
Right.
So Michelle, why don't you tell people? Oh, go ahead.
I was going to say, one thing I do want to point out, in addition to, the fact that it all has to go snail mail, that's not something we're choosing to do, but the refund could be taxable. So you would need to get that information that we prepare in the 941X to your tax preparer to make that determination of how and when you need to account for the refund.
Yeah. And Michelle mentioned snail mail. The IRS has been very clear that they do not allow electronic filings of these amended 941. So unfortunately, it is all taking place through the U.S. mail and all the delays that come with that. So Michelle, why don't you just wrap this up by telling everyone how they can get in touch with us.
If you'd like to learn more about this program or speak with me or Mark, our contact information is on the next slide. We have a website which can be found at verusgpllc.com, or you can email us at info@verusgpllc.com. There's also a button on the website where you can request a consultation. Or if you're somebody that is familiar with, the existing company, Verus LLC, I believe there are also links on the Verus LLC website to the Verus GP LLC website.
And there's also a toll-free number there. If you prefer a phone call rather than email, just give us a call at 888-313-1006. And we thank you for your time today, and I think we'll now open it up for any questions from the attendees.
Thanks. So we did have some questions come through. The first one is, does one of two requirements mean either test 1 or test 2? We did not have a 50% decline in 2020, but we had a 20% plus decline in 2021. Would that qualify us?
Yes, a decline in excess of 20% for 2021 does meet the revenue decline test to qualify for the ERTC.
For that period of time.
Qualify, right. They may also qualify for 2020 based on government orders if we had more specific information about the business.
Okay. And I think this is along the same lines. If we don't meet test 1 or 2, can we still apply and get a credit?
Well, that's where I think the answer would be no, but determining whether you qualify under the second test, that's the full, whether your business was subject to a full or partial suspension or shutdown, that's a very fact-specific analysis, and it's not always obvious on the face of it. So that's where I think that's one of the reasons that we will spend a time with you to really understand your business and the impacts that the pandemic had on your business, to determine if it fits into the IRS guidance around this program.
Okay. The next one is, what quarters are used for comparison of loss?
Well, typically it is it's the quarters in 2019. So you would compare, let's say if you're trying to qualify for the first quarter of 2021, you would compare that to the first quarter of 2019. However, there are some alternate quarter comparisons that we're allowed to make. That's why on our questionnaire form, we ask for the revenue for every quarter from quarter 1 of 2019 through 2021.
Okay. And it says, how do you calculate your fee?
Mark?
You want to take that, Michelle, or you want me to answer that?
Yes,
Our
our fee is a 20% contingency fee based on the amount of the tax credit that you would actually receive. So we believe we know what that amount will be when we prepare the 941 forms for you, but if for some reason your refund amount differs from that, the fee would be 20% of what you actually receive, and only after you receive your funds.
And it would be an exceptional circumstance where it would be a different amount that you'd receive as a refund. Our experience to date, we haven't seen that for any of the businesses that we've seen that have actually received their refunds. We haven't seen the IRS disagreeing with the calculations.
Right.
All right. And then another question, why do I need it? Why can't I do this myself?
Well, I think that the short answer to that is that second test. If you didn't have a revenue decline that meets the first test, 50% in 2020 or 20% in 2021 quarter over quarter, the second test is very complex. And it requires somebody who's really read and understand not just the IRS bulletins that have been put out with guidance around this program, but also other elements of the Internal Revenue Code and the authorizing statutes that created this refund, this tax refund, the CARES Act and the ARPA. And that's where we bring that knowledge and experience. Michelle has spent the last year and a half reading those acts, the IRS bulletins, the IRC, and our tax attorneys we're working with, our CPAs, know the ins and outs of all of those elements of the assessment.
And I like to point out, we actually represent multiple tax preparing firms in filing their own claims, and those firms have actually referred some of their clients to us because it's not something that they regularly do or something that they can easily understand in looking at the act and the guidance.
Okay, and it looks like we have time for one more question. There are a few other questions in here, but we'll go ahead and send you a copy of them as well. But the next question is, can you address the option to use a prior quarter in 2021 to qualify for the credit? Can that quarter be double counted to qualify a business for the 2 consecutive quarters?
Could you read that question again?
Yeah.
Sure. Can you address the option to use a prior quarter in 2021 to qualify for the credit? Can that quarter be double counted to qualify a business for the 2 consecutive quarters?
Short answer is yes and no. It can be used for the quarter immediately preceding the one you're trying to qualify for, or if the decline does not rise above an 80% of pre-pandemic levels, that decline is considered to continue consecutive quarters until the first quarter where the decline is less than 20%. That makes sense.
Okay, that sounds good. Now,
As with many things when looking at the tax code, it's very, very complex, and the answer is often, it depends.
okay, thank you. All right, so that is all the time that we have for questions today. Do you have any last words or thoughts?
I think we've covered the territory pretty well, but again, if there's a question that occurs to you after you've thought about this a bit, you've got our contact information. Feel free to reach out, and we'd be happy to talk you through.
Okay, great. Thank you.
Thank
Thanks again. You will be receiving a recording of today's webinar and the PowerPoint slides via email. Lastly, when we close out the webinar, a survey will come up on your screen that will, I hope that you will fill it out so we can understand how to best provide your important information in webinar format. Our next event is tomorrow, the Women Business Leaders Council meeting. That is at 9 a.m. So if you are interested, you can go to our website at njbia.org at /events. So until next time, for Mark Evelyn and Michelle Benton, this is Amy Music thanking you for being with us today, and have a great day.
Thank you.